There's a moment in history when an entire nation realizes it's been living a lie. When the ground beneath their feet turns out to be nothing more than smoke and mirrors. And that moment is happening right now in America, exactly 95 years after it destroyed the most powerful economy on Earth in 1929. Picture this. It's October 23rd, 1929, and millions of Americans are about to wake up to the most brutal financial reality check in human history. But here's what should terrify you. The warning signs had been screaming for months, the same warning signs that are screaming today. The exact same patterns, the exact same delusions, the exact same financial house of cards built on nothing but collective belief and borrowed money. And just like 1929, everyone is convinced this time is different. But before we dive into why history is about to repeat itself with devastating precision, let me paint you a picture of what those final financial hours actually looked like in 1929. Because when you understand how quickly everything collapsed, how suddenly fortunes evaporated, how rapidly the American dream turned into the American nightmare, you'll realize we're not just approaching a similar moment, we're already living in it. The summer of 1929 felt like paradise. The stock market had been climbing for nearly a decade. Ordinary people, factory workers, shop owners, secretaries, were making more money in the stock market than they were at their actual jobs. Everyone had a story about their neighbor who bought some railroad stock and retired early, or their cousin who invested in automobile companies and bought a mansion. The newspapers were filled with headlines about permanent prosperity, about how the old economic rules no longer applied, about how America had figured out the secret to endless wealth. Sound familiar? It should, because we're hearing the exact same stories today about technology stocks, about cryptocurrency, about real estate that never stops going up. The language is different, but the delusion is identical. Here's what most people don't understand about 1929. The crash didn't happen because of some external shock, some war or natural disaster. It happened because the entire financial system had become completely detached from reality. And that detachment happened gradually, then suddenly, in a way that feels eerily familiar to anyone paying attention today. By September 1929, the stock market was trading at valuations that made no mathematical sense. Companies were worth more on paper than entire industries had been worth just 5 years earlier. But here's the critical detail that connects 1929 to today. Most of those stocks weren't being bought with real money. They were being bought with borrowed money, with margin loans, with credit that existed only because everyone believed the prices would keep going up forever. The Federal Reserve, the same institution that controls our financial system today, had kept interest rates artificially low throughout the 1920s. Cheap money flooded into the stock market, creating artificial demand, driving prices higher and higher, convincing everyone that they were witnessing genuine prosperity when they were actually watching the inflation of the largest financial bubble in history up to that point. Does this sound familiar? It should, because since 2008, the Federal Reserve has kept interest rates near zero for over a decade, pumping trillions of dollars into the financial system, creating the exact same conditions that led to 1929, except this time, the bubble is larger, more complex, and more dangerous than anything the world has ever seen. But let's get back to those final hours, because understanding exactly how the collapse unfolded reveals why what's coming will be even worse than what happened before. October 24th, 1929. Black Thursday started like any other trading day. The opening bell rang at the New York Stock Exchange. Traders took their positions. But within the first hour, something was different. The selling pressure was intense, relentless, unlike anything they'd seen before. Prices weren't just falling, they were collapsing in real time. Here's what was happening behind the scenes. The margin calls had started. When you buy stocks with borrowed money and the stock price falls, your broker demands more cash to cover the loan. If you can't provide it, they sell your stocks immediately at whatever price they can get. This creates a vicious cycle. forced selling drives prices down, which triggers more margin calls, which creates more forced selling, which drives prices down further. By noon on October 24th, panic had set in. The trading floor was chaos. Grown men were shouting, pushing, desperately trying to execute sell orders before prices fell even further. The telephone lines were jammed with calls from desperate investors. The ticker tape machines that printed stock prices couldn't keep up with the volume of trades. People were selling stocks and waiting hours to find out what price they'd received, only to discover it was far lower than they'd hoped. But here's the most chilling detail. Throughout that entire day, throughout the panic, throughout the chaos, the financial experts, the newspaper columnists, the government officials, they all kept saying the same thing. This is just a healthy correction. The fundamentals are strong. This is a buying opportunity. The economy has never been better. They were saying this while fortunes were evaporating, while banks were failing, while the entire financial system was coming apart at the seams. They were either lying to prevent further panic, or they genuinely didn't understand what was happening. Either way, their reassurances were worthless. Fast forward to today, and we're hearing the exact same reassurances from the exact same types of people. The economy is strong, unemployment is low, corporate profits are healthy, any decline in the markets is just a temporary correction. But underneath these reassurances, the same structural problems that caused 1929 are present today, magnified by 95 years of increasing complexity and interconnectedness. The debt levels today make 1929 look conservative. American household debt is at record highs. Corporate debt is at record highs. Government debt is at levels that would have been unimaginable in 1929. And just like in 1929, much of the stock market gains of the past decade have been fueled not by genuine economic growth, but by cheap money, by borrowing, by financial engineering that creates the illusion of prosperity while hollowing out the foundation. But there's something else happening today that makes the current situation even more dangerous than 1929. The global financial system is now completely interconnected in ways that didn't exist 95 years ago. When the American stock market crashed in 1929, it took months for the effects to spread around the world. Today, a crash in New York can trigger immediate collapses in Tokyo, London, Frankfurt, and every other major financial center within hours. The speed of modern trading, the complexity of modern financial instruments, the interconnectedness of modern banks, all of this means that when the next crash comes, and it will come, it won't unfold over days or weeks like it did in 1929. It will unfold in hours, possibly minutes. And here's the most terrifying parallel between then and now. Just like in 1929, the warning signs are everywhere, but they're being ignored by the vast majority of people who have the most to lose. The yield curve has been inverted for months, a reliable predictor of recession. Corporate earnings are declining. Consumer confidence is weakening. Credit defaults are rising. Housing markets are showing stress. But just like in 1929, these warning signs are being dismissed as temporary noise, as speed bumps on the road to permanent prosperity. The same delusion that convinced people in 1929 that stock prices could only go up is convincing people today that the current financial system is stable, sustainable, and immune to the forces that have destroyed every previous bubble in history. The psychological patterns are identical. The financial structures are similar, but larger. The warning signs are the same, but more extreme. We're not approaching 1929. We're living in a more dangerous version of it right now. Now, the most chilling part isn't what happened next in 1929. It's what happened in the weeks leading up to Black Thursday that nobody talks about. Because if they did, every American would recognize we're living through those exact same weeks right now. September 3rd, 1929, the Dow Jones hits its peak at 381 points. Champagne flows on Wall Street. Newspapers declare the dawn of a new economic era. But hidden in the financial data, cracks were already spreading like fractures in ice. Industrial production had been declining for months. Steel output was falling. Railroad freight was dropping. Car sales were slowing. The real economy, the actual production of goods and services that creates genuine wealth, was already contracting while the stock market soared to impossible heights. This is the signature pattern of every major financial collapse. The divergence between fantasy and reality becomes so extreme that they exist in parallel universes. Wall Street lived in a world where everything was perfect, while Main Street struggled with the early signs of economic decay. Today, we have the exact same divergence, but amplified beyond anything 1929 could have imagined. Corporate America is announcing layoffs almost weekly. Tech companies that were hiring aggressively just months ago are now cutting thousands of jobs. Retail chains are closing stores. Manufacturing activity is contracting. Consumer spending on everything except necessities is declining. Yet the stock market continues to trade near all-time highs, completely disconnected from these realities. But here's where it gets truly disturbing. The financial instruments that exist today make the margin buying of 1929 look like child's play. In 1929, you could borrow 90% of a stock's value. Today, through derivatives, options, and complex financial products, you can control positions worth hundreds of times your actual investment. The leverage in the system today is so extreme that small price movements can wipe out entire portfolios in minutes. Exchange-traded funds, index funds, algorithmic trading, high-frequency trading, all of these modern innovations have created a financial system that moves at speeds that would have been incomprehensible in 1929. When the selling begins, and it will begin, the velocity of the collapse will make Black Thursday look like slow motion. October 19th, 1929, 5 days before Black Thursday, the market opened lower but recovered during the day. Financial experts breathed a sigh of relief. See, they said, the correction is over. The market is stabilizing. Anyone who sells now is going to miss the recovery. Buy the dip became the rallying cry, the same phrase we hear constantly today whenever markets show any sign of weakness. But what those experts didn't understand, what they couldn't understand, was that the system had already passed the point of no return. The margin debt had grown so large that any significant price decline would trigger an avalanche of forced selling that no amount of optimism could stop. The mathematics of leverage had taken control, and mathematics doesn't care about human emotions or expert opinions. Today's margin debt makes 1929 look conservative. Americans owe more money against their stock portfolios than at any time in history. But that's just the visible leverage. The hidden leverage, the derivatives, the synthetic products, the interconnected webs of financial obligation, create a system where the collapse of one major institution can trigger the collapse of dozens of others within hours. And unlike 1929, where the damage was primarily confined to America, today's financial system is global. American pension funds own European bonds. European banks hold American mortgages. Asian companies have borrowed dollars they can't repay if the currency strengthens. When the next crash begins, it won't be contained to Wall Street. It will be simultaneous, worldwide, and instantaneous. The morning of October 24th, 1929, started with what traders call a gap-down opening. The market opened significantly lower than it had closed the previous day. This should have been a warning that something fundamental had changed overnight. Instead, it was seen as a buying opportunity. Professional money managers, wealthy individuals, even banks started buying stocks at what they thought were bargain prices. They were catching a falling knife. Each purchase provided temporary support, creating brief rallies that convinced more people to buy. But the underlying selling pressure was relentless. For every buyer stepping in to support prices, there were 10 sellers desperate to get out before losses became even worse. This is exactly what we're seeing today in the early stages of market stress. Every decline is met with reassurances about buying opportunities. Every brief recovery is hailed as proof that the system is resilient. But the underlying fundamentals continue to deteriorate while the financial engineering becomes more desperate and more dangerous. The Federal Reserve today faces the exact same impossible choice that confronted them in 1929. They can raise interest rates to fight inflation, but that will trigger the collapse of an over-leveraged financial system. Or they can keep rates low and continue feeding the bubble, making the eventual collapse even more devastating. They've chosen to keep feeding the bubble, just as they did in the 1920s, and the result will be the same, only worse. By 11 a.m. on October 24th, 1929, the selling had become a stampede. Brokers couldn't handle the volume of orders. Telephone systems were overwhelmed. The physical infrastructure of trading was breaking down under the pressure, but the real breakdown was psychological. The collective belief that had supported stock prices for years was cracking, and once belief cracks, it shatters completely. Today's markets operate at digital speeds with algorithmic trading that can execute millions of transactions per second. When the psychological breaking point arrives, the collapse won't unfold over hours like it did in 1929. It will happen in minutes, possibly seconds, as computer programs trigger more computer programs in a cascade of selling that no human intervention can stop. The most terrifying aspect of our current situation isn't the size of the bubble, or the complexity of the financial instruments, or even the speed at which everything will collapse. It's the absolute certainty among the vast majority of people that none of this could possibly happen again. The same certainty that existed in 1929, the same blindness to obvious warning signs, the same refusal to acknowledge that the current system is unsustainable. We're not approaching the next 1929. We're living in its final chapters right now, and most people have no idea what's about to hit them. The most haunting words ever spoken on Wall Street came not during the crash itself, but in the eerie calm that preceded it. This is the way the world ends, not with a bang, but a whimper. Except they were wrong. The world of 1929 ended with the most deafening financial explosion in human history. And we're about to hear that same explosion again, amplified by nearly a century of compounding delusion. What happened in those final trading sessions of October 1929 wasn't just a market correction. It was the moment when mathematical reality collided with mass psychology at terminal velocity. And if you think modern safeguards, circuit breakers, and sophisticated financial instruments make us safer than those poor souls in 1929, you're about to discover just how wrong that assumption really is. October 25th, 1929. Black Friday. The day after Black Thursday, when everyone thought the worst was over. The morning newspapers carried headlines about stability returning to the markets. Leading financiers held press conferences assuring the public that the previous day's selling had been excessive, emotional, and temporary. The fundamentals of American business remained sound, they insisted. This was merely a healthy adjustment. They were lying, either to the public or to themselves, possibly both. Because while they spoke about stability, the margin clerks were working through the night, calculating which accounts had fallen below minimum requirements, preparing thousands of margin calls that would go out with the morning mail. Each of those letters was a financial death sentence, demanding immediate cash payments that most recipients simply didn't have. The psychology of bubbles follows the same script every time. First comes denial, then anger, then bargaining, then depression, then acceptance. On October 25th, America was still trapped in the denial phase, convinced that willpower and optimism could overcome mathematical impossibility. The anger phase was just beginning. By noon, the selling pressure had resumed with even greater intensity than the previous day. But now it had a different character. This wasn't panic selling by nervous small investors. This was institutional liquidation. Banks were selling. Insurance companies were selling. The smart money, The professionals who had created the bubble were quietly heading for the exits while publicly urging others to stay calm and buy more. This institutional betrayal is happening right now in 2024. While central bank officials speak about soft landings and controlled inflation, while Treasury secretaries reassure Congress about economic strength, the insiders are positioning for collapse. Corporate executives are selling their own company's stock at record rates. Pension funds are quietly shifting allocations. Sovereign wealth funds are diversifying away from American assets. The smart money is already gone. But here's what makes today's situation exponentially more dangerous than 1929. Back then, when a bank failed, it failed locally. When a company went bankrupt, it affected its employees and immediate suppliers. The contagion spread slowly, giving people time to react, to adjust, to find alternatives. Today's financial system is a single interconnected organism. When one major institution fails, it doesn't just affect its immediate network. Through derivatives, through counterparty relationships, through algorithmic trading connections, that failure instantly spreads to every corner of the global financial system. We've created a financial doomsday machine that makes the 1929 crash look like a minor regional disturbance. October 28th, 1929. Black Monday. The day that shattered whatever remained of American financial confidence. The market opened in free fall. There was no recovery bounce, no dead cat bounce, no technical support levels, just relentless, unstoppable selling that overwhelmed every attempt at intervention. The ticker tape machines that printed stock prices were running hours behind the actual trading. People were selling stocks in the morning and not finding out what price they'd received until evening, only to discover they'd lost everything. Fortunes built over decades evaporated in single transactions. Millionaires became debtors between breakfast and lunch. But the real horror wasn't the speed of individual losses. It was the realization that the entire system had been built on nothing but collective belief, and that belief was evaporating in real time. Stock certificates that had seemed as solid as gold became worthless paper. Bank deposits that had seemed guaranteed became frozen assets. The social contract that held American capitalism together simply dissolved. Today's financial system rests on even shakier psychological foundations. At least in 1929, companies produced actual goods, actual services, actual value. Today's market leaders are valued primarily on speculation about future possibilities. Artificial intelligence companies worth trillions of dollars that have never turned a profit. Cryptocurrency exchanges valued higher than century-old banks. Social media platforms whose primary product is the psychological manipulation of their users. The disconnect between market valuations and underlying reality today makes 1929 look rational by comparison. But the psychological mechanisms are identical. Collective belief creates collective value, until the moment that belief cracks, and then collective value becomes collective delusion. And collective delusion becomes collective catastrophe. October 29th, 1929. Black Tuesday. The day that ended the American century before it had really begun. The final day when the mathematical impossibility of infinite growth on finite resources collided with the immutable laws of financial physics. The volume of trading was so enormous that the physical infrastructure couldn't handle it. Telephone systems collapsed. Telegraph lines were overwhelmed. Runners carrying trading slips between offices literally collapsed from exhaustion. The New York Stock Exchange floor was ankle-deep in discarded paper, the physical manifestation of vaporized wealth. By the closing bell, the Dow had lost nearly 13% in a single day. But that number doesn't capture the human cost. Families that had mortgaged their homes to buy stocks on margin didn't just lose their investments. They lost their homes. Small business owners who had pledged their companies as collateral didn't just lose their stock portfolios. They lost their livelihoods. Retirees who had moved their life savings into the market didn't just lose their nest eggs, they lost their ability to survive. Today's interconnected global economy means that when the next Black Tuesday arrives, and it will arrive, the human cost will be orders of magnitude higher. Pension funds holding trillions in overvalued assets will collapse overnight. Retirement accounts will evaporate. Social security systems dependent on market returns will become insolvent. Health insurance companies, life insurance companies, disability insurance companies, all will face simultaneous bankruptcy. But here's the most chilling parallel between 1929 and today. In both cases, the people with the most power to prevent catastrophe are the same people who benefit most from perpetuating the bubble. Central bankers, treasury officials, regulatory agencies, they all have institutional incentives to keep the party going as long as possible, even when they know it will end in disaster. The Federal Reserve officials who kept interest rates artificially low throughout the 1920s weren't evil. They weren't stupid. They were trapped in a system that rewarded short-term thinking and punished long-term responsibility. The same trap exists today, only deeper and more inescapable. Modern central bankers face an impossible choice. They can raise interest rates to reasonable levels and trigger an immediate collapse of the over-leveraged financial system. Or they can keep rates artificially low and guarantee an even more devastating collapse later. They've consistently chosen the second option, buying time by making the eventual reckoning more catastrophic. The final weeks of October 1929 weren't just the end of a bull market. They were the end of an entire worldview, the death of the belief that American capitalism had solved the fundamental problems of human economic organization. The Roaring Twenties died in those final weeks, and what emerged from the wreckage was a decade of depression, hardship, and social upheaval that reshaped American society. We're living through the final weeks right now. The same delusion, the same denial, the same mathematical impossibility dressed up as financial innovation. The same experts reassuring the public while privately preparing for catastrophe. The same institutional failures, the same psychological patterns, the same inevitable conclusion. But this time, the collapse won't be contained to America. This time, it won't unfold over weeks or months. This time, the interconnected global financial system will ensure that when the bubble finally bursts, it will happen everywhere, simultaneously, at digital speed. The only question remaining isn't whether it will happen. The only question is whether you'll be prepared for what comes after. Because the world that emerges from the next collapse will be as different from today's world as the post-1929 world was different from the Roaring Twenties. And that transformation begins the moment enough people realize what we're really living through. The final financial hours aren't coming. They're here. History doesn't repeat, but it rhymes with terrifying precision. And right now, the rhythm is building to the same crescendo that shattered America in 1929. Every warning sign we've examined, every parallel we've drawn, every mathematical impossibility we've exposed leads to one inescapable conclusion. We're not witnessing the approach of another financial crisis. We're living in the final act of the greatest financial bubble in human history, and most people are sleepwalking toward the edge of an economic cliff that will make 1929 look like a gentle correction. The margin calls are already starting. The institutional selling has already begun. The smart money has already positioned for collapse. The only thing missing is the moment when collective belief finally shatters, and that moment arrives without warning, just as it did on Black Thursday, just as it always does. But here's what 1929 teaches us that no one wants to hear. The people who survive financial collapse aren't the ones who see it coming and panic. They're the ones who see it coming and prepare. They're the ones who understand that when the mathematical impossibilities finally resolve themselves, real assets matter more than paper promises. Physical security matters more than digital wealth. And community connections matter more than portfolio balances. The final financial hours aren't a prediction, they're a mathematical certainty. The only choice you have is whether you'll face them prepared or whether you'll join the millions who will wake up one morning to discover that everything they thought they owned was nothing more than entries in a computer system that stopped working overnight. If this opened your eyes to where we really are in this cycle, hit subscribe, because when the collapse accelerates, you'll want to understand not just what happened, but why it was always inevitable and what comes next.